This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 272, and we welcome back a very good friend of the show, Globe and Mail writer Rob Carrick. And this week we're going to talk about the state of Canadian personal finance. Rob is such a great guy, great experience, and talks to so many Canadians through his various media that he gets a real sense of what's going on in personal finance in Canadians. So it's great to have him back on. And we just realized he was on 100 episodes ago, in episode 172, as well as episode 39. So Rob's a longtime writer, personal finance writer in the Globe and Mail. I've known Rob for well over 25 years, so it's super fun to have him back on.
Yeah, I think he's 27 years doing personal finance at the Globe, something like that.
Yeah,
he's been doing it for a long time though. But he, like you said, Cameron, he's got a real boots on the ground perspective, and he actually tells us during the conversation that he's got a survey that he sends out through his newsletter, and he'll ask questions just if he's getting a sense that maybe something's going on, but he's not seeing it yet in the economic data, and he's not seeing any publications about it. He can ask questions to his many thousands of readers, and he'll get many thousands of responses back. So he's actually able to get, now it's a biased sample, which he acknowledges, but even so, he's able to get insight, aggregated insight into how people are feeling about certain topics before that data is surfaced anywhere else, which I think is really interesting.
So his personal finance column appears twice weekly in the Globe and Mail. He has a portfolio strategy column that runs on alternating Saturdays, also in the Globe. He also has a twice weekly email newsletter called Carrick on Money that he puts together that accumulates the best personal finance and investing material that he's found online. He also co-hosts the popular podcast Stress Test.
Yeah, that's
Ben, anything else to add?
No, that's a good introduction. Stress Test is a cool podcast, though. They do they talk to people, like they talk to, kind of like the survey thing that I mentioned. They talk to people about what's really going on in their lives, just to regular Canadians. It's a nice podcast. Anyway, I think that's a good introduction. So we'll go ahead to our conversation on the state of Canadian personal finance with Rob Carrick.
Rob, it's great to welcome you back on the Rational Reminder Podcast.
Glad to be here.
Yeah, it's super great to see you. So we have a number of topics to get to with you today, including investing, housing, and retirement. But first, we have to ask you, what are some of the big topics currently affecting your readers?
Well, I'm getting a lot of hard luck stories these days. People who win a jackpot of one sort or another, and I think that's increased a little bit. Just financial stresses are mounting. So there's people having problems with debts. They're having problems with trying to get money out of our DSPs, our ESPs, all sorts of things. I think the stress level's ramped up a little bit. I don't want to over dramatize that, though. I know there's like tons of headlines about how Canadian households are struggling. My sense is a lot are very far from struggling. They're actually done pretty well in the last few years. But so you've got sort of two groups. There's the struggling group, and then there's the pretty comfortable group. And the struggling group is they're reaching out. The comfortable group are asking a lot of questions about interest-bearing investments these days. Lots of interest in GICs and high interest savings account ETFs. People are very, very interested in getting a 5% return with no market risk. I'm a bit surprised. I mean, in summer 2022, I think somebody came up with a 5% GIC, and I wrote a story and it got a lot of play on the website. And I thought, let's see how that goes. And there's been a real strong flood of money into those products and a lot of interest from readers in them. And it just reminds me that people really want good returns without risk.
Yeah, well, that's one of the questions we want to ask you about, actually. Do you think people are playing it too safe by piling money into GICs?
I think we're probably at the tipping point for that. There was a lot of money piled up in checking accounts during the pandemic lockdowns. And so where did it go? It's almost all gone into conservative interest paying investments. And I think a lot of that money probably would ideally be going into the markets for superior longer term gains. I think people are extrapolating 5% today and thinking that's my new return from conservative investments, when in fact, no, it's a peak we're at right now. And I certainly understand short-term money, grab up that 5%. But if you expect to retire in 30 years based on GICs, we're at the top of the mountain and we're going down pretty soon. And I think people need to recognize that they'll need to move some stocks into their portfolio to get where they want to go.
Yeah. We actually have, we covered that exact, we had very similar comments on a recent podcast episode, and we've got a YouTube video coming out today at noon, actually, the day we're recording on the same topic. But I totally agree. I think there's a lot of long-term risk in expecting to get that 5% forever, which I think was what a lot of people see.
Yeah, that's it. That's it. If I had some money that I was confident that I didn't need and could live with the complete lack of liquidity, a 5% GIC at 5.5% or 5.2 or whatever it is, looks pretty good as a piece of my overall broader portfolio with exposures all over the place. I mean, 5% is a nice threshold. And I made a prediction a couple of weeks ago that, not really a prediction, but I sort of put it out there that we might hit 6%. And I do see that one of the alternative banks is offering a 6% 18-month GIC. Not bad.
Yeah, crazy.
Not bad at all. So one of the popular evolutions in the Canadian ETF market are the asset allocation ETFs. Based on your interaction with your readers and listeners, how impactful have these been in Canadians, how they approach their investing?
I would say I would give them a 10 out of 10 for importance as a product introduction in the Canadian investing marketplace, maybe 10.5 out of 10. It's very rare that I have an opportunity to tell people, just do this. Just do it. Just buy an asset allocation. Pick balanced, pick conservative, pick aggressive, pick all equity. I don't care which one you pick. Just do that. And I'm very confident you will have a good investing outcome if you can keep your hands off it for 10 years plus. And people are slowly picking up on this. They fight the idea, though, because they want more complexity. That's too simple. That can't be right. And I tell them, yes, it is right, and it is simple, but simple is a virtue. It's not a criticism. So I look at the assets, and I think it's a very strong, healthy amount of assets they've gathered. What is it, about 15 billion? I'm thinking in aggregate, but it could be more. Could be a lot more. So glass half full, glass empty. I'm going to say half full. They've really come a long way since in the 6 or so years they've been around. But a lot more money could be in them. Readers are interested, but not hugely interested. It's like a little trickle of queries about them. I just had one the other day. It's almost like you have to sort of talk people through it and encourage them that this simple, easy to do investment approach is right for them. And I think once I haven't heard very many critiques of it. People who are in are usually pretty happy with what's happening.
Yeah, it's such a good point on simplicity, sometimes making it harder for people to actually stick with that investment. They want to add whatever. Should I add a tech index? Should I add a bank index?
Exactly. You know what? They're not happy unless they're complexifying the simple investment. But really, I mean, if you dig down into a lot of these products, they have everything you need. They have emerging markets. They got exposure to the S&P 500, which means you've got your tech. It's really everything is in there. You don't need to get too cute in building those. And I am glad to see that for the most part, the ETF companies offering these products have resisted what I'm sure is a temptation to start adding like trends of the moment to these products to make them sexier. Like, let's put all the products in, let's put a hedging component in, let's do real assets. No, they're sticking to the major asset classes. And I think that tells me that this is, that they've got their heads screwed on straight about how these products should work.
Yeah. You even wrote about TD recently. They simplified their product. They had a more complex product, and yeah.
That's true. They took the active management out, which was a small portion. They went to index tracking for the whole thing. They were able to lower the fee, and I think that's a win-win. They're basically using like big broad market index tracking products, and that was able to chop like 5 basis points off the fee. I think that's a pretty big win.
Yeah. Do you have a favorite issuer of the asset allocation ETFs?
Well, I mean, I don't really. I think there's an interesting interplay between cost and construction and all that sort of thing. I mean, I give Vanguard points for bringing this to Canada. You know what?
Yeah.
To me, it was a perfect example of what Vanguard brings to an investing environment. Very investor forward thinking. There's really nothing about it that's trendy or cute. It's really plain vanilla type investments. Not the cheapest though. I mean, it's interesting to see Vanguard hanging out there at the high end. TD put a new floor in. I think. I would expect the MER for its products to be about 0.18. And there's Vanguard up at 0.25%. It's not a huge difference, but I mean, every bit counts. And Vanguard usually is a firm leader on costs, and they've been sort of caught out here. I'm curious to see if there's any developments on that front.
So, Rob, you and I have been pretty active in this industry for 20, 30 years, and it's over 30 years for me. How would you say the ETF market today compares to the mutual fund market of 20 to 30 years ago?
Oh, Cameron, you know what? It's funny. I think you read my mind with that question, because I get those blasts from the banks every week or month about the new products that are being issued.
Yeah.
And I was starting to think the mutual fund alarm was going off. Like, there's a lot of trend chasing going on now. There's a lot of product that I really question whether it's going to be around in a few years. I mean, I look at the closures of products. It reminds me a lot. It reminds me of a industry that feels that it is maturing and will need to come up with all kinds of new flavors to keep investors interested and to bring new money in. And I think a lot of the products that are coming out aren't really worth owning and never will be worth owning. And I find with the trend chasing that it often happens when a trend is peaking, and that means there's really very little upside left to capture. So I do find that there's the idea that we need more products, not better products. That's where I think it is. Now, that said, there is still a excellent core of very low cost ETFs out there that are outstanding ways to build a portfolio, and ETFs will always have that advantage over the fund industry. The fund industry was sort of fat and happy in that day. They never wanted to play ball on fees. They've since incrementally changed that, but ETFs remain at their heart an excellent product. But they are I think they're struggling to figure out, how do we build our brand, how do we build our asset base, and a lot of it is flaky products.
Yeah, that's what I was going to say. To me, the big difference is fees. Like, you can build beautiful portfolios now, like you said, for 18, 20, 25 basis points. But back in the day, fees weren't even discussed. And you've been to many of these mutual fund roadshows, like a long time ago, where fees would have been well north of 3%, and it was never even contemplated.
I think the mutual fund industry is still fighting the ideas that fees matter. I was just a reader got in touch the other day, and they have an advisor at a pretty big advisory firm using mutual funds. Their average MER is about 2.5%. And the advisor was talking up like all the package of things you get for this and all the service you get. And he was saying, well, I don't really get the service. And he was asking sort of me to help him figure out whether there was any value there. And I was thinking, here you are in a world where you're trying to defend a 2.5% fee. You could build an ETF portfolio for, as you say, I 10 to 20 basis points, add on an advice fee of 100 to 125 basis points, and you're half what the mutual fund portfolio is. And so, yeah, in mutual fund land, fees are, there are some cost conscious companies, and MERs are falling, but they're falling so slowly, and the average fees are still very high.
Yeah, it really is incredible. The Morningstar does the global fund investor experience survey in Canada. The fees are coming down, but very slowly.
Here's an interesting anecdote I'll tell you about all of this. The number of inquiries I get from readers about mutual funds? I'd say 3 a year. And so they say that index investing is the passive investing. I think mutual fund investing is the passive investing. People are just not asking questions. They basically win out all the questioning, searching investors who want more returns, want lower fees. And what's left in mutual funds are very sort of people who are willing to farm out the work to their advisor, listen to their advisor, follow instructions, and aren't asking a lot of questions. I think mutual fund industry has sort of created a base of people who are okay with what it's doing.
That's such an interesting observation, because when you look at the assets in mutual funds, they still swamp ETFs.
Yeah, the ETFs have much more momentum, but mutual funds, I mean, they're just a tick away from 3 trillion in assets, if I'm remembering correctly.
Yeah, crazy stuff. I think you nailed the dynamics of the ETF market. By the way, we had a professor on a few episodes ago, and he talked about how issuers can compete on cost for the total market ETFs, and we've kind of seen that go maybe to a floor or close to it. And then the other way that they can compete is by launching attention-inducing products, or like interesting products, and that's the kind of flaky stuff that I think you're talking about.
Right, and it's interesting that that stuff often has much higher costs than the index tracker. So you can run an index fund with, even if you're using sampling, you probably got hundreds of stocks in there. And here you've got this specialized portfolio. Let's say banks, for example. Look at the cost of the bank ETFs. They're way higher than the broader market ETFs, and you're talking 6 stocks.
Yeah, so crazy. What do you think about the long proclaimed death of the 60/40 portfolio?
Well, I think it came back to life. It was only dead for a year. You know what I mean? It was a stunning year for bonds. I mean, like I think the benchmark bond index fell like 11% on a total return basis. That is stunning. I've never seen the likes of that. And Cameron, you bet you haven't either. So the 60/40 had an epic fail last year, but it's coming back this year, and I think that all the people who are still in those portfolios will realize soon that they didn't blow their brains out with that choice. But I do think that it was a good opportunity for people to reassess their asset allocation. I mean, was 60/40 the right one for you? Should it be 70/30? Or do you think you're going to live to be 90 or 100? Maybe it should be 70/30. There was a lot of talk. In fact, I was just rereading a column I wrote a little while ago on, the old, like, 100 minus your age. Should it be 110 minus your age, or 120 minus your age? And if you use those methods of calculating, the weighting of stocks and bonds, then you do end up with higher asset allocations. But 60/40 seems to resonate with people. It's like it hits them right in the gut as something comfortable. I'm giving a little tilt to stocks, but I got lots of bonds. I think that, I think when the world rights itself, and when interest rates go down and bonds get those capital gains as well as the interest, the 60/40 portfolio is going to have a great year.
Nice. So you mentioned value from advisors. What proportion of Canadians do you think are getting comprehensive advice from their financial advisor?
So I had a JD Power survey on advisors and customer satisfaction with it. And I think, I'm going on memory here, but I think it says something like 6% were getting what JD Power set out as comprehensive financial planning and, services that go beyond just managing investments. So what I take from that is that very few people are getting comprehensive. I think a lot of people were probably a little fuzzy on all this. And when they answer these surveys, I find these financial surveys give out results that I just don't believe a lot of times. Like half of people can't afford $200 for a financial emergency. I mean, come on. I think the way they're worded, I think the way they're put out there, I think the way they catch people at dinner and they're not really thinking, they'll say anything to make the surveyor go away. I don't believe half the data, and the 6% sounds a bit low, but I don't think it's very low. I think most investors are just getting their portfolios managed, and they may get a little chat about taxes, and they may get urged to open up a FHSA for their kids or that sort of thing. And maybe the advisor has systematized their contributions to all their accounts, like it's going to come out of your account, go in every month. But a financial plan, a conversation about goals, I mean, a look at estates and wills and taxes and all that stuff, I think a minority are getting that, probably a very small minority.
Where do you think the resistance, if there is resistance, is it on the consumer side not really necessarily wanting it, or is it up to the industry to compel people to seek out planning advice?
It's a little bit of both. I think people want it. If you said, Cameron, would you like us to do a big financial plan on you before we get to your investments? You'd say, yes, please. But the process of doing it is laborious and I'll go have to find out numbers and I don't know where to find them. And eventually I'm going to lose interest and think, oh, maybe this could all just go away. I mean, I've been through it myself, and I was surprised at how many factoids I had to go find for the planner. And it was a bit annoying, but I was very curious about the results. So I was quite motivated. And I don't understand why people aren't more motivated. You got to tough it out and do this. So I would put a little bit of onus on the individuals, but it's also the industry. You know, it's all about selling. It's a selling business. It's not an advice business. And it likes to pretend otherwise. It likes to pretend it's an expertise business, but really it's about selling. It's about pulling revenue out of client portfolios. And the planning is kind of like, that's like you're idling. You're sitting in neutral. You're not driving forward doing that. And so I think it's partly the industry. Now, the industry is making moves. I'm hearing the term planning used a lot more by people in the industry, but I'm not sure what the net effect is on people. Like, is there a financial plan? Like, have you had a conversation with the person? Like, what's driving the investment choice? Did you just do a quick risk questionnaire and then off to the races? I think that's what's happening most of the time. And I think there's a big disconnect between what people want and need and what they're getting from the advice industry. I mean, my email in basket is full of questions all the time. And I would say about 4 or 5 times out of 10, I'm sending people lists of investment advisors. These are advisor questions, planner questions. And a lot of them say, oh, thank you, I'm really open to doing that. Why are these people not already working with planners and advisors? Well, I suspect some don't have the assets, or some can't find the right person. I think there's like 2 solitudes out there. There's the planners and advisors, and then there's the clients. And half the clients, or some percentage of them, are finding you, and you've got good relationships and it's going well. And then there's a whole chunk of people who aren't matched up with advisors or planners who probably should be. And I think I challenge the industry to find a way to serve these people at whatever asset level they have. I mean, there's all this talk about how AI is going to change the advice business. Well, I can think of a great way. How about you figure out a way to serve people with small portfolios?
Right.
Yeah. It's not an easy problem to solve. We know that.
It is not, but I don't think people are expecting you to reinvent the wheel here. Just some rudimentary thing that will help people organize their thinking and keep track of things would be sufficient. It's better than zero. That's what I think you need to think about, is what's better than zero. Zero advice. No, we don't need perfect. We don't need something for high net worth people that could be fit into an AI thing. It's just, what do you own? How much are you saving? How much do you think you want in retirement? Let's connect the dots and see how it goes. That's all we need.
Yeah, which is possible with technology that's out there. It's just finding the somebody with the business model to make it work.
Right.
To build it.
Exactly.
Yeah. I want to move on to housing. You wrote a really, I don't know, I'd call it provocative article on how much of housing affordability issues are related to actual affordability, and how much of it is related to people expecting too much when they're looking for a house.
Yeah, that column was based on some comparisons of the cost of living of cities in Canada and globally, and I was pretty shocked to see that Canadian cities are really not in the game for global expensiveness. We are well down the list, and so it made me think, what is the issue here? And it's, I think, we have this idea, it's cultural in Canada, that you must own a home. That legitimizes you and means you're on the road to success. And people want a house. A condo will not be sufficient. A townhouse is a good starter. They want a house, and you know what? I don't want. I hate being the one to tell people they're asking too much. You're shooting too high. You can't have things. I try to help people figure out how they will get the things they want. But I think people are. If the housing market of today is the true value of housing, then a lot of people are, if they expect to own these houses, are asking too much. I think they're going to have to lower their sights a bit. I mean, I think it's going to have to be, I will have to move out of an expensive city like Toronto or Vancouver, maybe work remotely and live in a smaller town, or I will settle for a 2-bedroom condo and raise some kids there, or we'll try to get a townhouse in the city, or if I want a big house, I'm willing to go way out to get it. I would like to see more more construction of houses of a more modest type, so that people could say that's an affordable option for me. It's not as big as I want, but it's attainable to me. So I think it's a mix. People are expect more than they can probably achieve, but maybe we need to give them more options that will be suitable for them.
So what are some of the challenges of that, climbing the property ladder where you start with something small and then upgrade again, which is quite typical, I think.
Yeah, it is. But the problem to me is you buy a condo. I mean, I totally see it. You want to get into the property market, you want to stop renting, you want to own your own place and start building equity. But I think the problem is that our idea of housing was built on the 10 to 20 most incredible years the Canadian housing market will ever have. We've seen the best. I will tell you that I think we've seen the best years. And so we expect that all I have to do is buy a condo, let it go up 10% a year, and then I'll cash out and I'll use that as the down payment on my other place. And I can push the risk level to the max, because I know that my house will start appreciating in value as soon as I buy it, and all my worries and risks financially by carrying this big mortgage will be offset by my rising equity, and at the end of the day, I'll look very smart for having done this. What if you get into the condo market and the condo market flatlines? Then you've paid all this cost to get into the condo. Then you're going to have to pay all these costs to get out of the condo. You're going to have to take on a bigger mortgage when you move. That's the risk. The risk isn't that the market sort of supports you by delivering chunks of new equity every year. And we're seeing a lot of, like, take a look at what's happened to all the people who bought investment condos. The math is working against them, and it works against you if you want to move up the property ladder. I would encourage people to think about buying a 10-year house or property. Where can I buy in and I can live here for 10 years. Build up your equity a lot before you move. Don't expect to jump from place to place to place. I mean, that was totally feasible in the past few years when house prices were rising all the time, and you could every property you bought was a launch to a better property or a bigger property. More staying put would be very good for people's personal finances.
Yep. Yeah, we've used that sort of 10-year rough rule of thumb too. I think that makes a lot of sense. So if it's not buying a condo, where do you think people who want to get into the housing market in the next 5 years should be parking their money?
Well, if you're parking your money and you're saving your down payment, then I would say you have to be in something safe. And so for me, I would probably open up an investment account and use a high interest savings ETF, get 5.3%. I would use maybe a trading app like Simple Trade, because I'm not paying any commissions, so there's zero friction. And I would just let that sucker pile up. And if interest rates start to come down, I start to look at what the alternatives are. But the high interest savings account ETFs track the Bank of Canada's overnight rate, and the Bank of Canada isn't in any hurry to lower that rate. So I think you're going to get your 5. And then it will, the Bank of Canada is probably going to make a bunch of little quarter point cuts very gingerly to see how things go. So you'll see your returns go down a little bit. I wouldn't want to lock money up in GICs, probably because I know when people are looking for houses, sometimes it happens quicker than they thought. Oh, yeah. And you don't have to go and ask how to cash out of a GIC and find out the penalty is like a pint of blood. So that's why I like high interest savings account ETFs. Also, investment savings accounts, those are like savings accounts packaged like mutual funds. The yields on those are 4.5% to 5% right now. That's pretty good too. I would use one of those. That's what I would do.
Yeah, makes sense.
Yeah, we agree. How common is it these days for adult kids to live with their parents?
It's way common. It's common. Now, what age do you or when you use the term adult kid, what age do you think you mean?
I'm thinking like mid to late 20s.
Yeah, it's happening into the 40s.
What?
Wow.
Yeah. I'm super interested in this. I mean, I have 2 millennial age sons, and they both live in Ottawa, they live on their own places. But earlier on, they were sort of in and out of the house, sort of the revolving door kind of thing. And so I'm really interested in this sort of thing. So I've done surveys in my newsletter to ask what's happening. And yeah, there are adult kids in their 20s, 30s, and early 40s living with their parents. The reasons are all over the place. Some it's cultural. In certain cultures, you live at home until you get married and buy a house.
Okay.
And that's perfectly normal. In fact, it's quite sensible in some ways. And I expect we'll see more of it happening because there's the affordability side of it too. Rents are exorbitant. And how do you save for a house down payment if you're paying $2,500 a month in rent? I mean, it's just really, and if you have a student loan as well, through sheer practicality. I mean, there's a little judginess built into these topics. Like, why are these young kids living with their parents? What's wrong with them? Well, sometimes nothing is wrong with them. They're actually quite astute on personal finance, and they're lucky to have nice parents, and it's a good arrangement, and they can go and get out from under these high rents and build up some home equity, and away they go. And maybe they can also put some money away for retirement, start a little investing. They can max out their FHSAs because they're not paying rent, or they're paying minimal rent. I think something like about half of parents are charging their kids rent, and usually it's a nominal rent, and many of them aren't actually taking the rent per se. They're actually putting it in investments for their kids, and they'll give it back to them. It's just sort of teaching them a little discipline of, shelter costs money, and we're gonna like act that out with this rent. So that's what's happening. It's super common, and I really got onto the topic of kids living at home, or young adults living at home, back in 2009 after the financial crisis. And it was like, remember the boomerang kids, these losers who were going home to live with their parents? What's wrong with them? The failure to launch. And now it's really normalized, although you don't hear a lot of talk. People don't go around bragging that my kids are living at home. It's like they sort of mutter about it with people and commiserate. But it's normal now, and I'm standing back and thinking a lot of these people are doing smart things.
You mentioned parents charging their kids rent. Are you seeing any parents sell part or half of their house to their kids?
I've seen it happen once. I actually wrote a column about it or I think in early August. It was a guy reached out to me and said, "We're doing something really interesting with our house. My partner and I have bought half my parents' house, and we've turned it into sort of a duplex.
Hmm.
We put a lot of reno bucks in, and they've basically the parents live on the ground floor. The younger couple lives on the upper floor. They've created like separate heating and cooling units, separate entrances. But it's a nice old house in Toronto that the younger couple could never afford to live in. And now the parents have little support. They're into the retirement years. The young couple thinks, if we start a family, we've got built-in daycare. And it was working out pretty well. And I thought, anyway, I wrote a column on it. It seemed to get a fair amount of engagement. I think that's a model, really. I mean, I'm hearing a lot of talk about, I want my kids to inherit my house. Well, why wait till you're dead for that to happen? What if you're a kind of big old city house in Toronto or Ottawa or any Canadian city, and you're not using it all as parents, and you're thinking, should we downsize? I don't want to be doing all the work. What about having your kids come in, spend some money to remodel? And I kind of think the resale value on those houses will be huge, because you're going to have a market of people who want to do the same thing as you when you go to sell. So I don't think it's happening a lot, but I think a lot of people are open to the idea and exploring it. It's complicated. You need a lawyer, but to me, it's a problem solver.
I'm conflicted in this next question because I live in suburban Ottawa, where there are fields, hundreds, thousands of new homes being built. But are more Canadians giving up on home ownership?
Yeah, you know what? They say they are. That's the thing. There's a lot of young people who are really sort of depressed about the economy and affordability and stuff, and they're making big statements like, "I'll never own a house. I'll never have kids. I'll never retire." And I think, you know what? You're 20 something. Wait a few years. Think life is long. Things happen. You'll feel more optimistic as time goes by. So a lot of people say they're giving up on home ownership, and but I question whether that's that. If we flash ahead 10, 15 years, I bet they'll be owning houses somewhere, somehow. Maybe it'll be a condo, maybe it'll be a house in one of those fields near you. So I don't really, the home ownership rate is down a bit. It peaked out at about 69%. I think it's backtracked a little bit, but maybe it was a bit artificially high because of all this, home ownership lust
Mhm.
that was so prevalent, during the boom. But I don't know. I think this is Canada, and I don't see a path towards substantially less home ownership anywhere right now. Um, I don't know what would change our minds. Maybe a honking big crash,
Hmm.
like something along the lines of what happened in the U.S. But I would not predict that happening in Canada. I think I'm actually surprised everything that's happened. I'm actually surprised at how well people are managing to keep their mortgages on side. There's been very few bits of evidence that people are walking away from their houses. I mean, you hear a few anecdotal stories, people putting their houses up for sale because they can't afford their mortgages. But my wife and I bought our first house in Toronto in the early 90s, and I know what a crashed housing market looks like. Every house for sale is on sale for less than it sold the previous time,
Yeah.
and that's not happening.
Who do you think's been hit worse in the last year or so? Renters, you mentioned rents have been soaring, or new homeowners with soaring mortgage payments?
I'm going to go with renters, and I'll tell you why. I mean, the homeowners have been hit hard. Like we could be talking hundreds and hundreds of dollars more a month, but they've got a house, and it will appreciate in value, and so they've got a solid asset underpinning all this pain, and they can always say, "Look, if we can weather this and stay in our house 10 years, we can be very confident interest rates will probably be lower, and or for much of those 10 years, and we're building equity." And we have a place to live and we can do what we want with it. The renters are getting hammered with higher costs and they've got nothing, there's no positive in all of this. It's
Right.
just cash being pulled out of their pockets. And I think in my personal finance role, and I've talked to other people on our Globe personal finance team about this, and I think this might be the number one personal finance problem for young people today is like
Hmm.
higher rents. What do we do about it? I mean, you can't tell people, oh, we'll just go rent in some far-flung city. It doesn't work out that way, It's like the remedies available for getting affordable housing don't all apply to renting. And what we're seeing is just like these double-digit year-over-year increases consistently. It's depressing. I don't really know what to offer people.
Hmm.
Yeah. How have Canadian housing returns compared to stock market returns for the last decade?
I was just BMO Economics did a report on this recently, and the stock markets. What's interesting is what I took out of this. The Canadian stock market beats housing, but what beats the Canadian stock market is the S&P 500. Like there was like S&P returns, TSX returns, and housing, and I was thinking, well, what the lesson here is have stocks, but also make sure you have a lot of American stocks. Yeah, housing, the stock market did better than housing. And I took a look, I did a look at myself at this over the past 10 years. And I thought housing did a nice job. It doubled the rate of inflation. Very nice outcome if you own real estate, but stocks did better. And I know people always throw the tax argument at me, which is 100% true. You can sell a house, principal residence, tax-free, but stocks offer liquidity, and I think you have to put a value on that. Like house is a terrible asset for using to generate any usable income. You have to borrow against your own house, and stocks you can manage. You can take profits. You can collect dividends. It's like a much more usable asset. So people always forget to put that into their comparison. But yeah, I think there's no doubt stocks have outperformed houses, and I I know that doesn't really resonate with people. They don't believe it. They don't care. They really prefer houses. You must find this in your work that people just light up when they talk about real estate investing.
Oh yeah, people love it. There's something about it, um, and particularly in Canada, it seems.
The phrase income property. How many times have you heard
Right.
that in the past year compared to the previous 20 years? I like I people who I know who I would never expect to say saying to me, what about an income property? They want it. They want it bad. And I was reading like this another part of that same report from BMO Economics on comparing returns on houses and the stock markets was also noting that it's not a great time to buy an income property.
Hmm.
Prices haven't come down all that much. Interest rates are sky high, but people are like, are they're this is what they really want.
Yeah. You mentioned the illiquidity of homes. What do you think about the idea that people can rely on their home equity as part of their retirement plan?
My answer to that is how. If you need income to pay the bills, how does your house give you that? It's the only way to make a house provide a huge chunk of living income is to sell it and rent or downsize substantially. I mean, like probably to something much smaller, much further away. I mean, unless you've got some giant mansion and you're going to go down to a two-bedroom condo or something. But I find that anecdotally, a lot of people who downsize, what they're downsizing to isn't dramatically less money than what they're selling, because a lot of people want to go much more urban into a nicer neighborhood. And so you're downsizing, but you're moving up market in certain ways. So that aspect of it isn't going to help you generate retirement income. And so you've got this asset with appreciating equity, but how do you tap into the equity? So you've got to get a home equity line of credit, you've got to get a reverse mortgage, both like expensive, very, very expensive right now. I mean, the interest rates on both of them are high, hefty. The minimum interest payment, if you want to take a couple $100,000 of equity out, that is a big nut to carry every month. So all of that considered, I say, if you're retiring and you want to supplement your income, your CPP, your OAS, your own savings, maybe you have a company pension with your house, how do you do that? Like if you're talking to 65 and you think you're going to live to 90, how do you make 25 years of income come out of a house?
I have to ask you about reverse mortgages, Rob. I've been doing this a long time. I have yet to meet anyone that's used one. Do you have much experience talking to people about successfully using reverse mortgages?
No, it's an interesting point. No, I have not. Now I'm not, like, by the same token, I would say that's a plus and a minus. I haven't heard a lot of complaints. I had one time an advisor got in touch with me, and he had a client who had one, and he was aghast at the interest rate. And this was back when interest rates were kind of low. And well, that's the cost of a reverse mortgage, take it or leave it. But I haven't had a lot of people get in touch with me and say, I got one and it was the worst mistake I ever made. It's the kind of product that people don't talk about a lot. This may be controversial, but it's a product that isn't, people with the high levels of financial literacy probably aren't going to get one. People who have advisors who have provided good comprehensive advice over the years probably aren't going to get one. So it's kind of like it's like a mystery clientele. These people, I don't really have a lot of, I haven't really heard a lot of anecdotal about them. But I think that a lot of people are rich in home equity and not much else. Why would you not consider a reverse mortgage? It's very expensive, but that's the tool and that's the rate. And it's a way, I think, of getting yourself out of some financial problems using what you have, home equity. And yes, you'll get less for the house when you sell, but maybe that's not so bad. Maybe your heirs will have to settle for less.
Yeah.
So that you can pull some equity out of this and live a comfortable life. I mean, that some people are just rich in home equity, and this strikes me that's a way to turn it into something useful.
Yeah, and you're shifting risk to another party, so that's going to cost you something.
Exactly, and you know what? It's like, I think it's a tool that. It highlights this sort of residual conservatism in Canadians in regards to their finances and investments. Like they're wide open to Bitcoin and all this stuff, but somehow they won't take a reverse mortgage out on their house. And so the people in this business are, revenues are increasing steadily. The percentages are pretty impressive, but the base remains fairly small. But there are now 3 or even possibly 4 players in. And the fact that we're getting more players, I think that might raise the floor on this thing, just getting the word out more. But I think we'll know it's really arrived when some big name financial player decides to get into this, if it ever happens.
Interesting. Now, you must hear from a number of retirees. Can you give us a sense of some of the non-financial challenges that they face entering retirement?
Yeah, I in my newsletter, I recently put a link to a piece by a retirement expert who was talking about this feeling that retirees get, this realization that I'm not as special as I thought I was. I'm not the hero of the workforce anymore. I'm not like this esteemed colleague. I'm not this respected leader or team member. And it's a hard adjustment for like hard working boomers. And it's sort of like you walk out of this action-packed work life to crickets. And it's hard to make the adjustment. It's hard to fill your time with meaningful activities. And there's a number of people out there who can't wait to leave and they just embrace it and they play golf and all that stuff. But if you're not a golfer, or even if you like just a bit of golf, but you're used to that work-induced adrenaline, and I can sort of relate to that, then it can be a hard adjustment. And I think the advice is to think about building a number of components in your life that will help you fill your time productively. So things like, physical activity and getting together with friends and finding new hobbies or things to learn about, or and let's not forget what I think a lot of boomers are going to try to do. I don't know how successful it'll be, is like a phased retirement. Work 2 or 3 days a week, be a consultant in your industry. I think that really resonates with a lot of people. It's great for your retirement finances too, because you're drawing down less, you're contributing a bit more, you keep your brain active. I could see, with people living to 90 and 95, I could easily see a lot of people retiring in their mid-60s and having sort of a 5-year runway to full retirement.
How much do you think retirees should be budgeting for dental and medical expenses?
Well, I asked around about this, and asked around on LinkedIn. I more and more I'm sort of putting questions out to planners and advisors on LinkedIn, and sometimes I get a lot of good feedback. And on this, there was a little sort of mini consensus about $5,000 to $6,000 would probably do it. They basically, and there was a lot of sort of smart ways of thinking about it. Like, if you have a plan, figure out what the cost of everything that the value of the plan, you're talking about a health plan through work, and then mark it up by 10% because you're getting older. That was one way to do it. Another was, factor in your own personal health. Does your employer, a small minority of employers, offer retirement health plans they keep them on the health plan? So there's that option as well. But by and large, I think $5,000 or $6,000 would cover it. If you've got like problems with your teeth, a couple of implants could probably use up that amount in a year. So that might want to be more, but it's a good reminder that when you are working and if you are part of a company health plan, make sure you get maximum dental usage out of it, so that when you retire, your teeth are in really good shape, because that can be a big money suck in retirement.
Yeah, those are big numbers.
Big numbers. And you know what, when you're doing sort of a little retirement planning, like I've done this in the last couple of years, what am I spending now? What will I be spending in retirement? And you just basically put this ledger down. What am I spending now? What am I going to spend later? So obviously the big one that comes off is in retirement. I'm not saving for retirement, but that's a big expense for me right now. What is new? Health. But who reminds you about that? Like, if you've had a company health plan for decades, you're just used to paying the copay amount. Oh, okay, $5 on my prescription, $30 on my dental visit. You think dental visits cost $30. And in fact, it's hard to even engage with what the underlying numbers are. Like the dentist I go to, it could be, $300-400 for a comprehensive checkup and cleaning. And that's a big expense just to come out of the blue twice a year when you're retired.
Speaking of surveys do you have any sense of how many parents are actually helping their kids financially, their adult kids?
90%.
90?
90% are providing, well, 92 actually, if I'm going from memory, are providing some sort of financial help. Now, it could be they're still on the family cell phone plan from when they were younger, and the parents just kept the plan going. It could be that the parents are paying their car insurance. It could be because they're on some family plan. It could be they're giving them cash every now and then to buy groceries. It could be they're helping with rent. It could be they're helping them with home down payments. It could be that they're providing shelter for them. But this is the new normal of parenting. I mean, you know what? One of the most interesting personal finance stories that I follow is how the cost of being a parent keeps rising and rising and rising. And so the latest entry in my notes on this is the Taylor Swift phenomenon. And how many parents are thinking, I have to get my kids tickets to Taylor Swift. How much is this going to cost? Well, you try to get the tickets online and you can't get them, and you're thinking my kid really wants it, and parents feel they have to deliver. You know, I read a story on I think the CBC website about some woman who got scammed in Toronto out of thousands of dollars that she felt she had to get her kid tickets. Now we can say, oh, that's what is wrong with these parents, but they feel it. And to me, that is it's a phenomenon now. Parents feel desperate to help their kids get to a certain level of affluence and success, and they're paying out of pocket money to make it happen. So it's like concert tickets for their teens and houses for their 20 somethings, and it's even more basic support, like helping to cover rent and groceries and stuff. I mean, there's I think there's a lot of parental anxiety about how their kids are doing and how well they're managing the cost of living.
Do you have a sense of how that's affecting parents' retirement savings?
I don't, and I'm really curious about that. I'm really curious to see the home down payment money that's been handed out. Where did that come from? CIBC Economics did a report about 2 years ago on it. It was so interesting. I mean, like phenomenal amounts of money, billions in aggregate, have been transferred from parents to young people. There's all this talk about the great wealth transfer. Well, I wonder how much of it's been drained out already by parents, giving down payment help. I think the average was something like $80,000, and wow. So where does that come from? I mean, there's a lot of high net worth families where they can reallocate money. But I suspect that some of it is line of credit money, and some of it is money pulled out of TFSAs and RRSP. So how will that affect retirement? Well, it's hard to say. It's a very abstract thing. Some people could say, well, I'll take one trip a year instead of two, and that will account for this block of capital I took out to give my kids. I think we won't really know. There's so many, I think retirement saving is really it's in a state of flux right now because there's expensive housing. There's this changing mindset of young people, like although they're pretty astute about personal finances, this idea of sacrificing and saving for retirement, they're not feeling it. And they're more in tune with short-term needs. So there's that. I do question. I think I'll be very interested to see how well people retire in the next 50, 60 years. I don't think I'll be around to watch it, but it will be interesting. Like, are people going to sock away? Like the boomers got it. Like they knew they had to do it. Plus they had all this home equity and they had rising stock markets. But today, people are very in tune with living in the here and now. And I don't want to fault them for that because there's a lot of reasons why that's so. But it does make me wonder about their retirement. And of course, what's the impact of their parents of having to help their kids? I know a lot of parents have to be thinking, I don't see how my kid's ever going to get a house. What can we do to help with that? And they will help to their utmost. And I think a lot of families are going to be having these conversations because when you look at what incomes are and what houses are, we've had all this economic disruption in the past year or two, and it hasn't helped a bit.
Now, what about the flip side? Adult kids supporting their parents?
Yeah, that's happening too. I think, I said a minute ago that I think young people are actually pretty astute financially. A lot of them are thinking, my parents, I don't have a high confidence level that they know what they're doing. And so I'm going to open up a line of conversation with them and ask and see what's what. So in some cultures, as I was mentioning earlier, families live together until the young people move out. But I also, in these cultures, it's expected that young people will step in to help their parents if required, and they may live together, they may provide financial support. So that's a big piece of it. But I think there are millennials and Gen Xers now who are realizing their parents maybe aren't quite that well set for retirement, and they're grappling with what can be done about that. And you asked me what people are emailing about. Way down the list are emails about, I'm worried about my parents. Just had an email from someone saying that their parents came to Canada in the early 2000s. They're not entitled to full OAS and GIS. They have a very small CPP, and it's not enough. So what else? And so that's an extreme one, but that's one to keep an eye on, because I think that you can live a pretty fun life, and then all of a sudden you cut to retirement and there's money. The money isn't there to keep it going, and then your kids are looking at you saying, "What's happening here?" And families will have to solve this. There's this sandwich phenomenon of supporting your elderly parents and your kids in some way. That's a thing that is big. The phrase was coined about 10 years ago, but I think it's really coming into its own now.
So do you have a sense of what adult kids are actually helping their parents with financially?
Well, I think some are helping them with cover rent, or with it's almost the reciprocal of parents helping their kids. It's like, what are the big costs? How much do you have? What can you not afford? Let me give you some cash. I think a lot of times it's just cash. Here, let me help you with the rent this month. Your house needs you need a plumber, I'll cover that cost. Your car broke down, I'll pay the cost to the mechanic, that sort of thing. It's on an ad hoc basis, sort of stepping in. And it's really, it's parents helping kids is sort of, we all know it's there. I mentioned earlier, it's not talked a lot about, but kids helping their parents, that's a really quiet topic. I put a survey into my newsletter on it, and more and more, and the newsletter that I do has a pretty big circulation, and I can get between 1,000 and 6,000 replies on it. So I'm using it more and more to ask questions that I'm not seeing being answered in other polling. And I put it out in our Globe universe. It's a fairly affluent universe, but a lot of the newsletter subscribers aren't Globe subscribers. They just read it. And so I'm getting a broader selection of people, and it's really helping me understand what's going on. And there's some really interesting things that are happening that aren't really getting a broader attention yet, because I guess they haven't really created waves that are showing up in the big economic indicators.
Do you think there's conversations that should be happening between those two groups, like adults to parents, regardless of which way the support might be going?
Yeah, that's a really good point, Cameron. I do think so. Like, almost like family. It's almost like you could do a support group. It's like, we're not out there to find fault or to find who's vulnerable and didn't do what they should have. It's like, how are you doing? Here's how I'm doing. And like, what are your thoughts on retirement? What are your thoughts on saving for a house? Maybe it's just exchanging intel on what you're seeing and what successes you're having. And maybe it's on you're asking for help. Like, I see that where we are now, and I don't see it all working out. And like, what could you do to give me a lift? Even if it's advice, because parents even if they're not great money managers, they've been through the wars, they've seen everything, and I think younger people can really benefit from that. It's not in my day this was happening. It's, here's how I got through this difficulty. We had our mortgage payments surge like in 1980. I couldn't believe we were paying 20%, and our mortgage payments surged. Here's how we got through it, and here's how quickly we renewed into a lower mortgage. I kind of experience is valuable. So yeah, no, I think intrafamilial discussions about money, that maybe at all ages, just to sort of compare notes and have a state of the union discussion.
I'm curious what you would do in this situation. So I had a 20-year-old plus or minus family member who showed some interest in financial planning. So I recommended and gave her a couple of books and recommended a couple of podcasts. What would you do to try to engage the younger generation in learning about not necessarily investments, but the whole financial planning process and the benefits of that?
That's interesting. People ask me that a lot, and I'm kind of stuck for an answer, because there's nobody's sort of done like the TikTok version of the basics of financial planning, turned it into something that's easy to digest, fun. It's delivered in an engaging sort of way. It's a wide open field, but I think podcasts are the way to go. Because I find that young people really resonate with this way of taking in information. It just works for them. And we do a podcast at the Globe, colleague and I, and it's called Stress Test. It's aimed at millennials and Gen Zs, and it's not about financial planning per se, but it is about finance, personal finance, investing, houses, all the costs and all the challenges and all the questions and the mix of priorities. And we've had a really, really good pickup on it. And there are other ones too, that other podcasts as well. In fact, if you look at the business podcasts on Spotify or Apple, there's a number of good personal finance ones in there. Some of them are a bit too tilted towards investing and what's hot and how real estate and Bitcoin and all that stuff. I would avoid those. But there's a lot on what are people worried about money? What are people worried about with respect to money? How are they getting past it? What's working for them? What are the big challenges? What are the pitfalls and that sort of thing? And I find that people who've never read the Globe and Mail stop me and say, I listen to your podcast. And they're all young and they it seems to resonate with them. And I'm a bit surprised to the extent that's happening. So that would be my recommendation podcasts.
I think that's a good recommendation. It's interesting how quickly the discussions often go to stock picking or Bitcoin or something in some app without even the basic knowledge of what is a TFSA, what is a high interest savings account, what is an RRSP, what is an FHSA, like just the account types.
Do you know my theory on that is that young people are hungry for financial home runs. They feel like I need something, I need wealth and I need it quick. So what's going to do that for me? Oh, Bitcoin, that's going up like 200%. Let me get me some Bitcoin. Is it GameStop shares that are doing that? I'm piling right into that. Their radar is pinging all the time for something that will give them a jump start. And they don't care about the niceties of whether it should be in their TFSA and all that stuff. They want the money and they want it now. And that's why they're wide open to all this stuff. And that's why some of the content providers are right on that. And how do I get ears? I'm going to talk about real estate investing and flipping and how this is a great time to get in on it. And Bitcoin had its moment, still out there, but I mean, crypto isn't quite as compelling as it was. But there will always be that sort of thing for young people. And I think they feel pressured that I need a house down payment. How do I get it? Well, maybe if I strike it rich investing, I'll get that. And so the other things will fall into line, they'll learn by doing. But I do think by and large, young people are pretty good at knowing the basics. Like they understand TFSAs. I was just looking at some TFSA contribution data, and I was surprised at the amount that like even 19 and 20-year-olds had in their 18, 19, 20-year-olds had in their TFSAs. There's a lot of money flowing into these accounts. The usage of them is pretty good. I mean, I think a lot of them have set themselves up with regular plans because you look at like 20 and 30 somethings, they're all making like 20 TFSA contributions a year. That means I'm putting little bits in when I can. Really smart. Like that's like if I said to you, can you afford 5,000 for a TFSA? You'd say no way, man. But if I said, what if you did a bunch of little contributions? You'd think, yeah, that's doable. They're doing that. Yeah. So I think they're doing some really smart things, but there is a hunger for something that will make them a lot of money quick.
Yeah, I think that's what we see too. Makes a ton of sense. I think that's the last of our questions, Rob. This has been we're calling this episode The State of Canadian Personal Finance with Rob Carrick, and I think that's exactly what we got from you.
Awesome. It was a great chat, guys.
Yeah, great to have you back on. So much fun. Thanks, Rob.